The $223 trillion secret, why U.S. banks are quietly preparing to take your deposits. There's a financial time bomb 70 times larger than the 2008 crisis, and U.S. banks are quietly preparing for the explosion. If you have money in a bank right now, you need to hear this. Welcome back to the channel. If you're new here, we cut through the noise to bring you the financial truth that mainstream media won't tell you. Today, we're diving deep into something that should terrify every person with a bank account. Let's start with a number that's almost impossible to comprehend: $223 trillion. That's the current size of the global derivatives market. To put that in perspective, the entire world's GDP is only about $100 trillion. We're talking about a shadow banking system that's more than twice the size of all economic activity on planet Earth. So what exactly are derivatives? Simply put, they're financial contracts whose value is derived from an underlying asset, things like stocks, bonds, commodities, or interest rates. Think of them as bets on bets. And just like in 2008, when the housing market collapsed and took down the global economy, these derivatives have become weapons of mass financial destruction. But here's what's different this time. In 2008, governments bailed out the banks with taxpayer money. Remember that? Trillions of dollars handed over to the same institutions that caused the crisis. The public was outraged. Politicians promised it would never happen again. And technically, they were telling the truth, because they've created something far worse. Enter the bail-in. Unlike a bailout, where the government uses public funds to rescue failing banks, a bail-in allows banks to convert their debt into equity by seizing creditors' assets. And guess what? Your bank deposit is legally considered a loan to the bank, making you a creditor. That means when the next crisis hits, your savings could be used to recapitalize the bank. This isn't conspiracy theory. It's written into law in the United States, Canada, Europe, and many other developed nations. The legal framework was quietly established after 2008. In the U.S., the Dodd-Frank Act contains provisions for bail-ins. In Europe, it's the Bank Recovery and Resolution Directive. These laws give banks the authority to freeze your accounts and convert deposits into bank stock in a failing institution that could be worthless. Now let's talk about why this matters right now. The derivative exposure at major U.S. banks is staggering. J.P. Morgan Chase alone has over $54 trillion in derivative exposure. Bank of America has around $21 trillion. Citigroup sits at approximately $19 trillion. These numbers dwarf their actual assets and capital reserves by astronomical margins. The banking system operates on a concept called fractional reserve banking. Your bank doesn't actually keep your money in a vault. They keep maybe 10% as reserves and lend out or invest the rest. Now imagine what happens when trillions of dollars in derivative bets go wrong simultaneously. The bank doesn't have enough reserves to cover the losses. Under the new bail-in rules, they can simply take depositor funds to stay solvent. You might be thinking, but what about FDIC insurance? My deposits are protected up to $250,000. And you'd be technically correct, but here's the reality check. The FDIC has only about $128 billion in its insurance fund. Meanwhile, there are over $18 trillion in insured deposits across U.S. banks. That's a coverage ratio of less than 1%. If multiple major banks fail simultaneously due to a derivative crisis, the FDIC couldn't possibly cover everyone's losses. So how did we get to this dangerous point? After the 2008 financial crisis, regulators promised to rein in risky derivative trading. They promised transparency and accountability. Instead, the derivative market has exploded in size. Banks have become even more interconnected, even more leveraged, and even more dangerous to the global financial system. The problem is that derivatives create what economists call systemic risk.
When banks are so interconnected through these complex financial instruments, the failure of one institution can cascade through the entire system like dominoes. And with $223 trillion in derivative exposure globally, we're not talking about a few dominoes, we're talking about the entire tower coming down. Major banks have also been lobbying hard to weaken regulations that were supposed to protect the system. They've argued that strict rules hurt their competitiveness and ability to serve customers. In reality, they've been fighting to maintain the risky practices that generate enormous profits in good times, while socializing the losses when things go bad. There are already warning signs that stress is building in the system. We've seen increasing volatility in bond markets. Interest rate derivatives have become particularly concerning as central banks around the world have been forced to raise rates to combat inflation. Each rate change creates winners and losers in the derivative market, and when the numbers involved are in the trillions, even small miscalculations can be catastrophic. Recent bank failures have given us a preview of what's coming. When Silicon Valley Bank collapsed, we saw how quickly a bank run can develop in the digital age. Within 48 hours, over $42 billion was withdrawn. The bank failed, and while depositors were eventually made whole through a combination of FDIC action and government intervention, it demonstrated the fragility of the system. Here's what most people don't understand. The largest banks are now even bigger than they were before the 2008 crisis. They've consolidated power, absorbed smaller competitors, and grown their derivative books to astronomical levels. The too big to fail problem hasn't been solved, it's gotten worse. And the solution that regulators have prepared is to make you, the depositor, pay for the next crisis through bail-ins. Financial institutions are already preparing their infrastructure for bail-ins. They've created detailed resolution plans, sometimes called living wills, that outline exactly how they would use depositor funds to recapitalize in a crisis. These aren't theoretical exercises, they're operational blueprints that can be activated when the derivative time bomb finally explodes. The trigger for the next crisis could come from anywhere. It might be a spike in interest rates that makes trillions of interest rate derivatives go underwater. It could be a geopolitical event that disrupts currency markets and foreign exchange derivatives. It could be a corporate debt crisis that impacts credit default swaps. Or it could be something we haven't even anticipated, a black swan event that exposes vulnerabilities we didn't know existed. What makes this particularly dangerous is the speed at which modern financial crises unfold. In 1929, the stock market crash and subsequent Great Depression unfolded over years. In 2008, the crisis moved much faster, but still took months to fully develop. Today, with algorithmic trading, digital banking, and instant global communication, a crisis could cascade through the entire financial system in days or even hours. Conclusion. So what can you do to protect yourself? First, understand that diversification isn't just about your investment portfolio, it's about where you keep your actual cash. Don't keep all your money in one institution. Consider spreading deposits across multiple banks, ideally staying under the FDIC insurance limit at each one. Second, consider holding some physical assets. This could include precious metals like gold and silver, which have historically served as stores of value during financial crises. Real estate, commodities, and other tangible assets can provide a hedge against banking system failures. Third, stay informed and be ready to act. Monitor the financial news for warning signs, unusual bank stock movements, sudden changes in bank policies, or regulatory announcements about systemic risk. Having a plan before a crisis hits is crucial. And finally, understand that this isn't about fear-mongering, it's about awareness. The $223 trillion derivative market exists. Bail-in laws are real. The next financial crisis will eventually come. The question isn't if, but when, and whether you'll be prepared. If you found this video valuable, please hit that like button and subscribe to the channel. We're building a community of financially aware individuals who refuse to be blindsided by the next crisis. Drop a comment below and let me know, are you taking steps to protect your wealth? What concerns you most about the banking system? Remember, knowledge is your first line of defense. Share this video with friends and family who need to understand what's really happening in the financial world. And check out the links in the description for additional resources on asset protection and financial preparedness. Thanks for watching, stay safe, and I'll see you in the next video where we continue to uncover the truth about your money.